What's up, everybody? Welcome to another episode of the Stock Bros podcast. My name is Tony. Today, we're going to talk about dividend investing and Dividend 101, dividends for beginners. But first, please subscribe, leave a like, leave a comment, let me know what you think. And also, check out my course I just put out on Udemy. It's the ABCs of Investing, Financial Literacy and Investing 101. It's all about things you need to know before you start investing, coming up with a game plan, and also understanding how investing works, stock market terminology, all the essentials before you start buying anything. And also you could check out my other affiliate links as well. So let's get started with dividends. So what is a dividend? A dividend is just when a company pays portions of its profits back to shareholders. So in its simplest form, dividends are just when companies will share their profits with you, and all you need to do is own shares of the company's stocks. It's as simple as that. Dividend payouts are actually in addition to any capital appreciations you receive from the stock. So dividends are just an added benefit to your capital appreciation, meaning if the stock goes up in value, you're still getting your dividends. If the stock goes down in value, you're still getting dividends. But it's important to note, not all companies will pay a dividend, and dividend payments are not guaranteed, and they can be cut or suspended at any time by any company. Now, this is highly unlikely if you're investing into a good blue chip company or companies that are known for paying dividends. And it's very simple to tell if or when a company pays a dividend. So let's talk about how dividend payouts work. So a dividend is paid per share per year of stock. And how you can find out how much a company pays is through the dividend yield. Dividend yield is how much you'll be paid in a dividend, and it's per year. So if a company has a 3% dividend yield and you own $100 worth of stock in that company, you'll be paid $3 per year, right? If a company has a 4% dividend yield and you own $100 worth of that company's stock, you'll be paid $4 per year. So the way it works with dividend payments is they're typically paid on a quarterly basis in the US, but there are some that pay monthly or semi-annually. But typically it's quarterly. And a company's board of directors, they actually approve the dividend, and then the company announces when the dividend will be paid, and they're using the ex-dividend date and the dividend date. That's the information that you'll need to understand when that payment will be made. Now, investors must own a stock on or before the ex-dividend date in order to receive payments on the dividend date. So the ex-dividend date is simply just the date that you'll need to own a stock by in order to be paid on the dividend date. And typically the ex-dividend date is a week or 2 weeks, or sometimes it's even just a couple days before the actual dividend date. So an example would be if an ex-dividend date is on January 1st and the dividend date is January 15th, this means that you'll actually need to own shares of that company by January 1st to be paid on January 15th, right? It's pretty simple. And if you miss the ex-dividend date, but you buy some shares after the ex-dividend date, you'll just be paid on the next pay period. That's all. It's not a big deal. So there's 3 things you need to know. And that's dividend yield, how much you'll be paid, ex-dividend date, when you'll need to hold shares by in order to be paid, and the dividend date is the date you'll be paid the actual dividend. Now, one source I use quite often for dividend information is a website called dividend.com. They have excellent information on there. It's free. You can look up the dividend yield. You can look up the company's past payout history. You can look up the ex-dividend date, the dividend date. There's a lot of great information on there. And another useful piece of information is actually how much of the company's revenue goes towards dividend payouts. That's also very useful information to know, and that's on dividend.com as well. So say a popular company like Coca-Cola is a popular dividend company. If it says 90% of their payouts go to dividends, that means 90% of their revenue is actually being paid back to shareholders in the form of a dividend. Why do they do this? Well, it's a way to get people to buy more shares of their company and actually hold shares of their company. That's one of the biggest reasons companies pay dividends, is an incentive for you to buy shares of their company. Now, let's talk about how dividends are paid and things you can do. How dividends are paid, they're typically paid as a cash payout, and this cash will be deposited in your brokerage account. Now, companies do have specialized bonus dividend payments or special annual dividend payouts. Not all companies do it, some do. If your dividend is paid as cash, it will be deposited into your cash account of your brokerage, not your bank account. And you can reinvest that cash back into the company that paid the dividend, or any company you want, or a new company, whatever you want to do. Or you can auto invest back into the company using something called DRIP. DRIP is Dividend Reinvestment Program. Now, what this means is any cash payouts you get will just be automatically reinvested back into the company that paid you the dividend payout in the first place. So what will happen is this will help grow your number of shares, which means you'll receive an even bigger dividend payout the next time one rolls around. And with compounding interest and dividend growth in general, it could add up pretty quickly, and it's a nice added benefit. So that's some of the reasons why people buy dividend stocks, is for passive income. It's also a peace of mind. If the stock market's crashing like we saw in 2020 and you're still receiving dividends, you're still making some money even though the value of your stocks are going down. So dividend paying companies will sacrifice growth because they're not putting that money back into building their company up or basically reinvesting back into the business, because dividends are more likely to be paid by well-established blue chip companies that no longer need to reinvest their money back into the company to grow the business because they're already a huge, large cap, successful company. Now, high growth companies such as tech or biotech companies, they'll rarely pay a dividend because they use this money to help expand their companies and reinvest the money back into R&D, research and development, and stuff like that. And sometimes when you specifically pick dividend companies, you will be sacrificing growth for a stream of income. So it's a way of building passive income. And what kind of dividend stocks and ETFs are there available on the stock market? Well, some of the really popular companies to look at are called Dividend Aristocrats and Dividend Kings. Dividend Aristocrat is a company that's paid its dividend for 25 years or more without a cut or a suspension. So these are really safe dividend stocks. And there's roughly about 60 of them in this club. And Dividend Kings are the same thing, but these are companies that have paid for 50 plus years. And there's roughly about 30 of those companies. There are a lot of really good dividend ETFs out there too. Dividend ETFs work exactly the same way as dividend stocks. You just simply look at the dividend yield and that will tell you how much that ETF pays. And one important note, if you're investing in dividend companies just to live off of that income, it's going to be very difficult to do because you're going to need a very large amount of capital. Even with $100,000 invested into a safe dividend stock that pays 3 to 4% per year, that's only $3,000 to $4,000 a year in dividend payments. I look at dividends as a way to supplement income rather than replace income. Until you get to the point where you have $1 million of capital, you're not going to really be able to replace your income with dividends. But it's a nice added bonus. It's nice supplemental income. And that's something to think about when you're going into dividend investing. So with that being said, please check out my links below for my course. See if it's something you're interested in. And also I have links for Acorns, one of the best ways to passively invest into the stock market. And I also have Public, Robinhood, and other links below. Check those out. And thank you for subscribing. Thank you for listening. And I appreciate all your support. Until next time, thanks again.